U.S. natural gas futures surged this week, on track for the best performance in over a month, driven primarily by intense heat forecasts across the eastern U.S. The early summer heat has pushed demand higher as power generators ramp up output to meet air conditioning needs. Beyond weather-driven demand, traders are watching broader geopolitical risks. Escalating conflict in the Middle East, particularly involving Iran, could disrupt natural gas production in the region. While the U.S. market is not directly tied to Iranian supply, the ripple effects could impact global LNG flows. For instance, any disruption might prompt increased spot market buying from countries like China, indirectly increasing demand for U.S. LNG exports. Meanwhile, a stubborn heat wave is expected to linger across the eastern states for the next several days, significantly increasing power burn and the use of natural gas by utilities to meet electricity demand. This surge has been the pivotal short-term driver behind this week's rally. However, this is a transient phenomenon, and Friday's trading hinted that the momentum may already be fading. On the supply side, limited production played a key role. Recent data shows that daily output has slipped slightly, tightening the balance just as demand is picking up. Flows to LNG export terminals remain strong, further supporting prices. These dynamics are increasingly significant for the Henry Hub contract, which, while domestic, is now more sensitive to global trends due to high levels of exports. So while the U.S. benchmark contract is not global in nature, it's no longer insulated either. Exports from terminals near Henry Hub, Louisiana, continue at elevated levels, making the market more exposed to international events than in previous years. From a technical standpoint, the market shows signs of near-term strength. A breakout above this week's high could open the door to a move toward the $4.50 level. However, the broader chart still features a large head and shoulders formation that hasn't been invalidated, suggesting potential downside if the rally falters. Seasonally, late June into July tends to be a softer period for gas unless extreme weather continues. In my view, while the short-term move has merit, I still favor lower prices over the longer term. For traders with a broader horizon, it may be wise to drop down to the daily chart and wait for confirmation of a reversal. But if the market breaks above this week's high, that $4.50 target becomes a realistic next stop. Overall, the current rally is built on a fragile combination of heat-driven demand, slightly lower production, firm LNG exports, and global geopolitical risks. It's a volatile mix, and one that makes natural gas a market worth watching closely. Please like, subscribe, and comment to support the channel. See you in the next one.